Korea's stock market just shut down for 2 days in a row. 2 weeks ago, I posted about how 1.2 million Koreans got margin called. So here's what happened since then. On the 28th of July, the KOSPI fell by almost 11% in a single day and trading was frozen for 20 minutes. And then on the next day, the 29th of July, it happened again. This is the first time in the exchange's entire history that trading was halted on back-to-back days, and a total of 16.2% was lost. To understand how this happened, we need to visit China. Earlier on 27th of July, a Chinese memory chip manufacturer listed in Shanghai. They are called CXMT, and on their first day, they closed 466%, raising $8.6 billion US. Now, CXMT doesn't actually make the advanced chip that Korea's SK Hynix can, but they do make the ordinary chips in phones and laptops, and they just raised billions of dollars to make more of it. Going back to Korea now, SK Hynix actually reported its most profitable quarter ever, but it still came in under what analysts expected. And by then, the news out of China had already sown doubts over whether Samsung and SK Hynix had already reached their peaks. If we remember from my first video, a margin loan is when investors borrow money to invest, and a forced liquidation is when those borrowed investments go poorly and the broker can forcibly sell the shares. Well, it happened again. On the 28th of July, retail investors borrowed 2.2 trillion won to buy the dip. 2 days later, the same group of investors sold 1.4 trillion won more than they bought, and a lot of that wasn't people changing their minds, it was forced liquidation. Every forced sale can push the price even lower, which puts the next borrower under pressure, and that's how a drop can turn into a free fall. And finally, on the 31st of July, Korea changed 2 rules. Number 1, to buy a leveraged product that is tied to a single stock like Samsung or SK Hynix, investors now need 30 million won in cash instead of the previous 10 million. A bigger cash buffer means more of a safety net for when the market swings just like it did. Number 2, and more importantly, shares already owned can no longer be used as the deposit, so existing investments can't be used to fund leverage bets. It's a preventative measure to stop the chain of events that leads to forced selling, and I did think that more regulation was needed here. Follow for more money content.